Hello, everyone, and welcome to Best Legal Tax/Corporate Structures for Your Business, presented by South Asian Chamber of Commerce and Ram Law Firm. Thank you, everyone, for joining. My name is Raza Merchant. I'm the managing partner at Ram Law Firm. I'm one of the speakers. The other speaker here is Jennifer Siegel. She's a corporate associate at Ram Law Firm. A little bit about Ram Law Firm. We specialize in corporate law, all things business, private equity, real estate, mergers, acquisitions, anything to do with business, as I said. And we're doing this with the South Asian Chamber of Commerce. If you haven't heard of the South Asian Chamber of Commerce, they provide great resources for businesses, learning opportunities, networking opportunities. An organization worth checking out. And Jennifer here will go over the roadmap of the webinar.
Yes, so we're going to begin by discussing the different business structures, each of their advantages and disadvantages, and then we'll get into some tax law and talk about the tax implications of each entity type so that hopefully you walk away with a better understanding of which structure might be best for your business. As attorneys, we obviously had to include a disclaimer just that this presentation is for educational purposes only. It's not intended to be construed as legal advice. Okay, so business organizations. What is corporate law? Corporate law is a legal practice area governing the formation, organization, management, and operation of corporations and other companies. It encompasses a broad range of legal matters related to their creation, financing, governance, and dissolution. It's a body of law that sets out the rules and regulations that companies must abide by in order to conduct business within a particular state. And it includes a wide array of topics related to the transactions of businesses, including mergers and acquisitions, corporate finance, and securities regulation. Corporate law also governs the internal affairs of a corporation, which we'll define and discuss later on in this presentation, including the powers and duties of its directors and officers, the obligations owed to its shareholders, as well as its interactions with society and regulatory bodies. This area of law is essential to the functioning of modern business and commerce. It provides a legal framework for corporations to raise capital, enter into contracts, and engage in a variety of business activities. Overall, corporate law plays a crucial role in shaping the modern business landscape, and it continues to evolve in response to changing business practices and regulatory environments. There's actually no federal corporate law. The area of law is instead overseen by the states. The Texas Business Organizations Code, or TBOC for short, contains the regulations governing businesses in Texas. The TBOC applies to all Texas corporations, partnerships, limited liability companies, and other domestic filing entities, as well as foreign filing entities that are registered to transact business here in Texas. Okay, so types of entities. First, we have sole proprietorships, which is the simplest of the business structures, and it's technically not even a legal entity. One person or a married couple is the sole owner and operator of the business, and there's no legal distinction between the owner and the business. So if you launch a new business and you're the only owner, unless you file a certificate of formation with the Secretary of State registering as a different entity type, you would just automatically be considered a sole proprietorship under the law without needing to register as one. However, if you're regularly conducting business under a name that's not your own individual name, you would need to file an assumed name certificate with the state. This business structure is most common among freelancers, consultants, and other service professionals. Next, we have partnerships, which are similar to sole proprietorships. However, the key difference here is that the business has to have two or more owners. So a partnership is defined as an association of two or more people who are associated to carry on business for a profit. And there are two different types of partnerships: general partnerships, or GPs, and limited partnerships, or LPs. We'll talk about the differences between the two types on the next slide. And then limited liability companies, or LLCs, I'm sure you all have heard of them. They are a hybrid entity combining the positive traits of a corporation, partnership, and sole proprietorship. So like corporations, which we'll discuss in a few slides, they offer limited liability protections, hence the name limited liability company. However, unlike a corporation, they have less paperwork and compliance requirements, similar to sole proprietorships and partnerships, but it is necessary to register with the state in order to form an LLC. The owners of an LLC are called members. If the LLC only has one member, it would be a single member LLC, and then an LLC with multiple members obviously would be called a multi-member LLC. An LLC can choose to be managed by its members or instead by its managers. This decision should be specified in its certificate of formation and in the LLC company agreement, which all LLCs should have a company agreement. At Ram Law, we would recommend making LLCs manager managed because it allows you to hide the identity of the owners of the LLC. In Texas, the names and addresses of the governing persons of an LLC are displayed publicly on the Texas Secretary of State's website. So forming a manager managed LLC keeps the identity of its members private.
I'm going to cover types of partnerships. Essentially, there's the two types that Jennifer just mentioned, general partnership and limited partnership. General partnership is kind of basically a sole proprietorship if there's two or more owners. So you're automatically considered a general partnership if that happens. In this scenario, both by default rule, or if there's more than two, well, however many partners there are, manage the business equally, and they share on the profits and losses equally. This structure is flexible, and again, no filings, nothing like that. But there can be modifications via a partnership agreement. And in that partnership agreement, you can then say, okay, this partner will do X, another partner will do Y, and you can have a little more formality. But again, this is basically a sole proprietorship with more than one owner. Then there's limited partnerships. Limited partnerships are actually registered, so it's different than a general partnership. You have to have a general partner and a limited partner. In this scenario, the general partner bears all of the liability. The limited partners, which are sometimes called silent partners in business, they typically have no control, and they are only liable up until their investment.
Okay, so types of entities, we're just going to discuss some of the advantages and disadvantages of each type. So sole proprietorships are the most common form of legal structure for small businesses because of how easy they are to set up. The pros of sole proprietorships are one person controls the business. You don't have to deal with shareholders or members. They're also easy and inexpensive to form and maintain. You don't need to file a certificate of formation with the state, as mentioned earlier, so there's no state filing fee. You're automatically considered a sole proprietor by the state if you start a new business and are its sole owner, as I mentioned previously. There's also no corporate formalities or paperwork requirements, such as meeting minutes, bylaws, etc. They have pass-through taxation as well. We will go into this a little more later in our tax law segment, but it basically means that the company does not have to pay taxes at the entity level. Instead, the income passes to the owner or owners of the company who pay personal income taxes for their share of the business. So for an S corporation, filing taxes is easy, as all you need to do is fill out and attach a Schedule C to your personal income tax return. But while it's the simplest form of organization, we strongly discourage structuring your business as a sole proprietorship because there's no real separation between yourself and the business here. As the sole owner, you are personally responsible for all of the debts and liabilities of the company, which can be potentially very dangerous. This means that if someone, it could be a customer, an employee, or just any other third party, sues your business and they win, They would be able to go after your personal assets, your car, your personal bank accounts, and even potentially your home. So due to this risk, most sole proprietors eventually convert their business into an LLC or corporation. Raza, did you want to discuss the other types?
Sure. So the disadvantages.
Sorry? Okay, so I'll just go over the advantages and disadvantages of the other three types. So as you can see here, for a general partnership, the pros and cons are similar to those of a sole proprietorship. The pros being they're easy and expensive to start. There's no filing fee since there's no need to register the business with the state. They're also relatively inexpensive to maintain, but it is important to create a partnership agreement since there's more than one owner, unlike a sole proprietorship. Again, there are no corporate formalities or paperwork requirements. They also have pass-through taxation. And as compared to a sole proprietorship where there's only one owner, in a general partnership, you don't have to absorb all of the business's losses on your own because all of the partners split both the profits and the losses. But the main disadvantage of a general partnership is that its owners have unlimited personal liability. So each partner is jointly liable for all of the partnership's obligations and liabilities. Also, many state laws hold each partner fully responsible for the actions of the other partners. And for these reasons, GPs are strongly discouraged as a form of business. Additionally, disputes among the partners can unravel the business if there's no partnership agreement, but drafting a partnership agreement would help mitigate this risk. And then limited partnerships are more common than general partnerships. LPs are used commonly in private equity scenarios. Multi-owner businesses that want to raise money from investors often register as LPs to allow these investors to avoid liability. So the advantages of an LP are the investors can serve as limited partners and thus avoid personal liability for partnership obligations. The limited partners also have the ability to leave the partnership at any time without needing to dissolve the partnership. Second, general partners get the money that they need to operate the company while still maintaining authority over the business operations. And then third, they also have pass-through taxation. But then the disadvantages, they're more expensive to create than a general partnership since you do have to register the business with the state. In Texas, there's a $750 filing fee, which is actually more expensive than the fees for forming an LLC or corporation. And second, general partners are personally responsible for the business's debts and liabilities. A lot of general partners get around this by forming an LLC to serve as the general partner for the GP, however. Also, a limited partner could potentially face liability if they inadvertently take too active a role in the business. Then we have LLCs, which are the newest type of business structure, but they've become increasingly more popular. The advantages are, first, there are not as many restrictions and formalities to follow as a corporation. The members of an LLC also have a lot of flexibility when it comes to the way the LLC is structured compared to a sole proprietorship or partnership. You have a lot of freedom when it comes to drafting your company agreement in the LLC. You can override the default LLC rules that would otherwise apply. For example, you can decide how much authority the managers or managing members, if you choose to do a member managed LLC, have, and you can designate specific actions that the governing persons are or are not allowed to take. You can also choose the way you want things like distributions and transfers of membership interests to work. Second, neither the members nor the managers are liable for the company's debts, obligations, and liabilities, except in rare circumstances. You can carve out exceptions to this rule if desired in your company agreement. The company agreement can expand or restrict any fiduciary duties and related liabilities that a member, manager, or officer has to the LLC or to the other members or managers. And then third, LLCs have the ability to choose whether they want to be taxed as a partnership or corporation, which we will discuss later on. The main advantage of an LLC compared to a sole proprietorship or general partnership is that it's more time intensive, since you do have to file a certificate of formation with the Secretary of State, and it's more expensive to start. In Texas, there's a $300 filing fee. So moving on to corporations. What is a corporation? It is a legal entity created under the laws of a state, which has its own privileges and liabilities distinct from those of its owners. There are a few different types. First, we have C corporations or C corps, which are the most common type of corporation and what most people think of when they hear the word corporation. It's the default type of corporation under IRS rules, meaning your company will automatically be classified as a C corp when you register with the state as a corporation, unless you elect to be treated differently. It's an independent legal entity that exists separately from its owners, who are called shareholders, and it also protects the shareholders' personal assets from creditors. So shareholders, board of directors, and officers are the people that control the corporation, and the main benefit to a C corp is the limited liability that they offer their governing persons. Then we have S corps. An S corp, it's technically a tax classification, not a legal business structure. The S corp tax status is available to American entities that meet certain requirements, which we'll discuss a couple slides from now. Entities that qualify can elect S corp taxation by filing a form with the IRS and receive certain tax advantages. And an S corp that doesn't meet these requirements would just automatically convert to a C corp. Then we have nonprofit corporations. A nonprofit is a type of corporation that is organized for charitable, educational, or other public benefit purposes, and they're exempt from paying federal income taxes. We're not going to discuss nonprofits today. We're going to focus on C corps and S corps, as well as the other entity types that we mentioned previously. So most businesses actually do not need to incorporate. Small business owners typically choose a different entity type when deciding how to structure their business, because there are many more regulations and tax laws that a corporation has to comply with. At RAM Law, we typically recommend only forming a C corp in 2 instances, which first would be if the business has a high level of income and does not issue dividends to its investors, and it's instead constantly reinvesting in the business. We typically engage a CPA to do this analysis with us to see if there's a tax savings in this scenario. So it might be a good idea to incorporate as your business grows. And then second, if you're a startup whose objective is to eventually get acquired by a larger organization or go public, a corporation is a better means for achieving that usually. It's easier to invest in corporations because of the way that corporations and their shares are structured. Oftentimes, startups also want to have several classes of stock and want to issue stock to their employees. So forming a corporation would be beneficial in this instance. Additionally, there are some tax advantages that only corporations qualify for, so it might be a good idea to form a corporation in those situations. Okay, so C corps advantages and disadvantages. The biggest benefit to a C corp is the limited liability it offers its owners. The corporation is completely separate from its shareholders because it's a separate entity. Its debts, obligations, and liabilities are its own. Those who do business with a C corp must look to the company to satisfy any obligations owed to them and not to the shareholders. So if someone sues the business and wins, they're limited to taking only the corporation's assets to cover the judgment. They can't come after your home or your car or any other personal assets. The shareholders' exposure to loss is just limited to the amount that they invested in the corporation. Second, the shares of a C corp are readily transferable, meaning that a shareholder can freely sell their shares, and the buyer will then take the seller's place as the shareholder and be entitled to the economic and management rights that accompany those shares. In an LLC, on the other hand, unless its company agreement provides otherwise, a member can sell the economic rights of their membership interest, but not the management rights. they usually would have to get the other members' consent to sell their whole membership interest. So it's just a lot simpler to transfer ownership in a C Corp. And then third, there's no restriction on the types of owners or classes of stock. C Corps can have an unlimited number of shareholders. Anyone can own shares, including business entities and non-US citizens or residents. C Corps can also issue more than one class of stock, including stock with preferences in terms of dividends and distributions. And then the main disadvantage here is double taxation. C Corps are separately taxable entities and are subject to double taxation, which means the profits of the company are taxed first at the corporate level and then again at the individual level when distributed to shareholders as dividends. The owners are also not entitled to deduct business losses on their personal tax returns, but owners who invest profits back into the business instead of taking dividends are more likely to benefit under a C Corp structure. Second, they are complex and expensive to form as compared to a sole proprietorship or partnership. A certificate of formation has to be filed with the state where you're registering your entity as a corporation, which in Texas involves a $300 filing fee. And then for a corporation, you'd also need to draft bylaws to govern the organization. Second, corporations are more complex to own and operate than the other entity types. You need to have a board of directors who manage the corporation, officers who run its day-to-day operations, and shareholders who don't directly manage the corporation but are entitled to economic benefits based on the number and types of shares that they own. And then lastly, the laws governing businesses require more formalities in terms of how a corporation is managed compared to the other types of entities. For example, corporations are required to hold meetings for the board of directors and annual shareholder meetings. They also have to give proper notice of these meetings, as well as they have to keep minutes of these meetings. In contrast, LLCs can be managed a lot more informally. There's no requirement to hold annual meetings with an LLC. So most small businesses pass over C Corps when deciding how to structure their business, but they can be a good choice as your company grows and you find yourself needing more legal protection. Then we have S Corps. Like a C Corp, an S Corp also offers limited liability to its owners. So the shareholders' personal assets are not in jeopardy if the corporation gets sued. But unlike a C Corp with double taxation, S Corps have pass-through taxation. So for small business owners deciding whether to form an S Corp or a C Corp, usually that decision comes down to how they want the corporation to be treated for federal income tax purposes. S Corps are pass-through entities, so the profits and losses of a corporation are passed through to its shareholders and reported on their personal tax returns. Then disadvantages, there are greater restrictions on who is eligible to own an S corporation as compared to a C Corp. S Corps are limited to a maximum of 100 shareholders. All of them have to be US citizens or residents. Another pitfall is that they can only have one class of stock, whereas C Corps can have multiple. S Corps are not allowed to have preferred stock, for example. Also, like C Corps, they are complex and more expensive to form than a sole proprietorship or partnership. Since an S Corp is a tax election, a company must first file a certificate of formation as either a corporation or LLC. Then the entity must make a timely S Corp election with the IRS no more than 2 months and 15 days after the beginning of the tax year that the election is to take effect. Also, like C Corps, they have complex ownership and management, and they are subject to more governmental regulation and formalities than some of the other business entity types.
Thank you, Jennifer. I want to pick up here on corporate governance of corporations. Corporations are structured a little different, where there's essentially 3 layers here. So there's shareholders, board of directors, and officers. Shareholders of the actual owners of the corporation, but they do not manage the day-to-day corporate affairs. They are essentially limited to electing directors, removing directors, voting on fundamental business transactions such as mergers, and they're not personally liable. The governance of a corporation is by the board of directors. Again, they're appointed or elected by the shareholders, but they oversee the affairs and decisions, but again, still not day-to-day operations. The day-to-day operations are handled by officers, and officers are elected by and chosen by the board of directors. In Texas, you need to have at least 2 officers, a president and a secretary, and it can be the same person. Next is these fiduciary duties. We want to cover fiduciary duties because these are things that need to be, looked at, because depending on your business, you can, as Jennifer mentioned before, you can limit, or expand these duties in your company agreements or bylaws. So the first is the duty of obedience. That basically means that you have a duty to obey the law and the governing authority of the entity. So you can't go beyond, directors can't go beyond what is authorized obviously by law and what's authorized by the certificate of formation. Next is the duty of loyalty. This means that the directors must act in good faith and not allow personal interest to prevail over the corporation's interest. This kind of has an extreme measure of honesty, selflessness, and good faith by the director. Basically, directors cannot usurp corporate opportunities, engage in self-dealing to the detriment of the corporation, or taking unfair advantage of the corporation to benefit themselves. And lastly, there's the duty of care. The duty of care is essentially a duty to act as an ordinarily prudent person would in similar circumstances. Basically, that you give care and you do due diligence before you make decisions. And there's the business judgment rule written underneath there. And basically, the Supreme Court, in a case, created this because they wanted to limit the liability of directors as long as they acted in good faith. So as long as you acted in good faith, and for example, you talked to a CPA, you talked to a lawyer, you talked to, you did feasibility studies, or even just analyze information. It's not necessarily relying on other professionals, but you actually did some good faith research and made a good decision. Basically the courts have come and said, we're not going to second judge directors, even if you make a decision that in hindsight seems stupid or not smart. They're not going to judge directors on that as long as they took reasonable steps in good faith. And if you don't, you could be personally liable. Next is piercing the corporate veil. So many people are shocked by this, that this could even happen. They say that I formed an LLC, I formed a corporation. How can I be personally liable? And you can be. Essentially, if you don't follow corporate formalities, the veil of the LLC can be pierced. However, in Texas, it's a little hard to do so. It's a very high standard. Basically, only when there's fraud involved, where basically you use the corporation as fraud or an alter ego as a sham for fraudulent activity. So it's a pretty high bar. But if you do that, they will come after you personally. And Delaware is very similar. It has elements of fraud, deceit, asset stripping. And each state's a little different. For example, California is one of the more easier places to pierce the veil. It's a little bit more fact specific and unpredictable in California. So it's something to keep cognizant based on whatever state you're doing business in, on what that would be. Other states have several factors. Is not commingling funds, following corporate formalities that Jennifer discussed. That every year you're supposed to have meetings, board meetings, minutes. They look at several of these factors to see, are you separate than your entity, and so something to keep in mind. But in Texas, where we are, it's a pretty high standard.
Okay, so which business structure is right for you? I'm just going to briefly recap the elements of each type. So sole proprietorships, the owner, there's just one owner, they have complete control of the company. They're easy and inexpensive to form, as there's no state filing required. There's also very little formality. They have pass-through taxation. However, the major disadvantage is the unlimited personal liability for the owner. General partnerships, very similar to a sole proprietorship, except it's 2 people instead of 1 owner. They're also easy and inexpensive to form since there's no state filing required. There's very little formality required. They also have pass-through taxation, but then they also have that same unlimited personal liability for the owners, which are the partners in this case. Limited partnerships, they do require a state filing, but they also have the pass-through taxation, and The limited partners, who are usually just the investors, are not subject to personal liability, but the general partners, who are responsible for actually managing the partnership, are responsible to the unlimited personal liability. So we typically recommend structuring your business as a manager managed LLC, but it's fact dependent and will vary based on each business's objectives and needs on which structure is right for your personal business. But LLCs are what we generally recommend. They combine the positive traits of the other entity types, but they also offer a lot of flexibility when it comes to their management and their operation. Creating an LLC allows you the freedom to choose things like the company's management structure and how profits are allocated among the members, compared to the other entity types, which are more rigid. They also have more choice when it comes to how they wish to be taxed, which we'll discuss in greater depth in our tax section. There's also less formalities to comply with as compared to a corporation. There's no requirements that they hold annual meetings or keep written minutes of their meetings if they do choose to hold meetings. And they also offer the same limited liability that a corporation does to their owners, which is huge. Finally, corporations, as we mentioned earlier, we would really only recommend forming one if your business is a startup looking to eventually be acquired or go public, or if your business has a high level of income and you're reinvesting this income in the corporation rather than issuing dividends.
Kind of a real world application of it all to summarize everything that Jennifer just said. Sole proprietorship and general partnership, stay away. We typically, unless you're starting a new business, you're trying to dabble and try something out. Okay, maybe. But typically people already have an LLC, but in case maybe you don't, okay, fine, then those two, sure, why not? But you are open to personal liability. Limited partnership, just think private equity, you're trying to get investors and do a business. LLC, obviously small business, most popular. Corporation is for startups trying to go public or large income, and it makes sense, and you're reinvesting and it makes sense for tax over a period of time to be a corporation.
Okay, so choice of jurisdiction. Which jurisdiction should you form your company in? Typically, only in unique situations would you want to form your entity outside of state lines, but that being said, Delaware is actually a first choice formation state for many, if not most, public corporations. Since the early 1900s, the state has been incentivizing businesses to form within its borders due to its lenient tax policies, reduced restrictions, and simplified corporate laws. So in terms of tax benefits, corporations registered in Delaware that don't do business within the state do not have to pay any corporate income tax. They also do not have a sales tax, investment income taxes, inheritance taxes, or personal property taxes in Delaware. The companies that are registered there do have to pay a franchise tax in order to register in Delaware, but this can be pennies compared to the income tax that other states would charge. Privacy for governing persons. As with registering a business in most states, companies need to assign a registered agent to receive mail and collect paperwork on behalf of the company. But unlike in most states, in Delaware, the registered agent is the only name that needs to be disclosed in connection with the company. Other officers and directors are not required to disclose their names, which allows for an extra degree of anonymity. Because of this lack of reporting, officers, directors, and shareholders are also not required to maintain residency in Delaware. Favorable case law. So the Court of Chancery is the court in Delaware that hears all business cases. It's made up of judges who actually specialize in corporate law. So corporate lawsuits don't go through a traditional trial system. Because of this, Delaware has a well-developed and predictable legal precedent that benefits corporations usually. And also the state's use of judges instead of juries and its prioritization of corporate cases allows business cases to be decided a lot more quickly compared to the average civil lawsuit, which can span a number of years. In Texas, the TBOC, which we mentioned earlier, is a Texas Business Organizations Code. It does treat corporations similarly to the way that Delaware law treats them, and Texas courts also tend to follow Delaware case law, which is beneficial for corporations. The downside to registering in Delaware is that your entity will probably be subject to more fees in the long run. Even if your entity is formed in Delaware, if you wish to do business here in Texas, you'll still need to register the business here as a foreign entity. And although you won't have to pay corporate income tax if you don't do business within Delaware, you'll have to pay the fee for registering a foreign entity in Texas, as I just mentioned, and you also might owe franchise tax in Texas in addition to already owing the Delaware franchise tax. So as your business grows, the cost of compliance in each state also might multiply. So a Texas business usually will save more money by remaining in Texas. There's no state income tax here, and the only amount Texas charges companies is for the franchise tax. But that being said, Texas only collects franchise tax from entities that meet a minimum revenue threshold, which is currently 1.23 million. Other states like California, for example, charge a franchise tax regardless of the company's revenue. In California, the minimum franchise tax imposed on each entity is $800 per year. So regardless of a company's revenue, they're paying at least $800 annually in franchise tax.
All right, so how do you actually do a lot of what we just talked about? And it's what I'm going to go over. The steps are pretty simple. Obviously, choose your entity type, which one fits you, depending on the type of business you're doing. Choose a jurisdiction. Are you looking for more flexibility, going public? Are you looking at Delaware? Are you looking at Texas? You have to make a decision there. Next is determining your name. Typically, you can always do a name search in the Texas Secretary of State before you actually find the name you like, file your registration. In Texas, that's called a Texas Certificate of Formation. It can be called Articles of Organization. There's different names for different states. Draft your company's governing document, very important. Applying for an EIN from the IRS. It's easy to go on the IRS website, apply for an EIN, and then also check if the type of business you have needs certain licenses or permits. Now let's go into maintenance and compliance. So you need to also make sure that all state regulations are followed. There are annual reporting requirements, for example, in Texas, a public information report where you have to disclose who's your director, who's your manager, kind of things, general information that the public should know. And obviously an annual report for your franchise taxes or a no tax due report. And of course, there's also corporate formalities that we did discuss earlier, your shareholders meetings, your board of directors meetings. All these things are important to ensure compliance, and more so in certain other states. So one thing I wanted to cover is common mistakes that we see pretty often. And the first one is inadequate research into entity types prior to formation. I see all the time where people choose, a S corporation when they shouldn't have, or a corporation when it should have been an LLC. So I think people who, especially are trying to do some sort of sophisticated business. Now, if you're trying to just do a small business, pulling up an LLC should be probably fine. But when you're doing a little bit more something a little bit more sophisticated or industry specific, business owners should spend at least a little bit of time saying, "Hey, this is what I want to do," and to go that way. So we see it all the time where we have to do entity changes. Second is no comprehensive operating agreement and bylaws. We see this actually quite a lot where people just form an LLC or a corporation and just go. Not sure if you're the only owner. I mean, it's an agreement between you and yourself. It might be okay. But when there's more than one owner, people come to us all the time saying, "Oh, we didn't have anything in writing. We have a corporation, we have an LLC, and there's multiple partners, and this causes a lot of problems." There's a lot of considerations, such as divorce, death, buyouts. So that could be covered in a buy-sell agreement or in your operating agreement. Voting, management of the company. These all need to be thought of before, because and it also stops fights or disagreements later on, when from the beginning you had all the difficult conversations and they were all done in the beginning, so everyone's on the same page. So when and if it does get to that point where maybe there needs to be a buyout or something happens, everyone knows the rules and everyone follows them. So that's a real huge common mistake that we see. And third is conflicting management in the formation documents. So, for example, a lot of people go on the Texas Secretary of State and form their own LLC, which is fine. It's pretty easy to do. It's a web form. I get it. You're trying to be quick and save some money. But when you form an LLC, the first checkbox is manager managed. So most people just tick that, and that's fine. The second box is member managed, and that's fine. We actually recommend manager managed. But then they tick that box and then they move on, and then they get their operating agreement online. And most operating agreements are member managed. And so we see a lot where the certificate of formation is manager managed, the certificate of and then the operating agreement is member managed, and now there's a conflict, and so then we have to go in and change that. And so these are things that to avoid. These are some common mistakes that we see.
Okay, so moving on to tax considerations. As we discussed, states typically impose taxes on the entities who do business within them. Texas is one of the few states that does not charge a state income tax. However, entities are subject to Texas franchise tax, as we mentioned, if they meet that revenue threshold, which is a privilege tax imposed on each taxable entity formed or organized in Texas or doing business in Texas. Then at the federal level, businesses must pay income tax to the IRS. All businesses except partnerships must file an annual income tax return. Partnerships file an informational return instead. Unlike sole proprietorships, partnerships, and LLCs, corporations pay income tax on their profits. They're subject to double taxation if dividends are paid to shareholders, which means the corporate profits are taxed twice, first at the corporate level when the company makes a profit, and then at the shareholder level when if and when the dividends are paid to shareholders on their personal tax returns. In a pass-through entity, the business is not subject to income tax at the entity level. Instead, the profits of the business pass through to its owners, who pay personal income taxes for their share of the business. Okay, so tax structures for the different entity types. Sole proprietorships have pass-through taxation. In a sole proprietorship, there's no separate entity. The business and its owner are considered one. So the business's income is the individual owner's income and will be reported on a Schedule C. Partnerships, they're generally not considered separate from their owners for tax purposes and are instead considered pass-through tax entities. So like sole proprietorships, they will also have pass-through taxation. All of the profits and losses of the partnership pass through to the partners, who pay taxes on their share of the profits or deduct their share of losses on their individual income tax returns. And each partner's share of profits and losses is usually set out in the partnership agreement. As mentioned, C Corps are subject to double taxation. They file a corporate tax return and pay taxes at the corporate level and face the possibility of double taxation if corporate income is distributed to shareholders as dividends, which are considered personal taxable income. Currently, the US corporate tax rate is 21%. S corporations have pass-through taxation. They file an informational federal return, but no income tax is paid at the corporate level. Any tax due is paid instead at the individual level by the owners. The profits and losses of the business are passed through to the owners and reported on their personal tax returns. So LLCs actually have a choice when it comes to their taxation, because for federal income tax purposes, there's no such thing as being taxed as an LLC. Instead, an LLC can be taxed like a sole proprietorship, a partnership, a C Corp, or if it qualifies as an S Corp. By default, a single member LLC is classified by the IRS as a disregarded entity. The term disregarded entity refers to a business entity that is separate from its owners, but that is considered to be the same as its owner for federal tax purposes. Essentially, the business owner wants the IRS to disregard the fact that the business is a separate entity when it comes to filing taxes. So a disregarded entity is a pass-through entity only for tax purposes. So the business owner can file business taxes with their own taxes. Thus, a disregarded entity is taxed like a sole proprietorship, meaning via pass-through taxation. However, if the owner of a single member LLC wants to, they can elect to have the LLC taxed as a C Corp or an S Corp instead. If you're a single member LLC with disregarded entity status, you're required to pay self-employment taxes. But by electing S Corp tax status, you'll be able to avoid self-employment taxes on the money that you receive as dividends. And then multi-member LLCs, they are treated as default as a partnership. So a multi-member LLC is a pass-through entity for tax purposes. Rather than paying taxes at the company level, the profits or losses are passed through to the individual members, typically in proportion to each member's share of ownership in the company. Multi-member LLC owners may opt instead to be taxed as an S Corp or C Corp. Choosing S Corp taxation does not change the pass-through taxation for the members of a multi-member LLC. The main reason to prefer S Corp tax treatment over partnership treatment has to do with the employment taxes. An owner of a business taxed as a partnership who is employed by the business is still considered an owner rather than an employee, meaning that they must pay self-employment taxes for all income, and any income generated is considered taxable income. However, an owner of an entity taxed as an S Corp can be considered an employee so long as they materially participate in the business. The owners are then paid a salary, and the business pays their payroll taxes, which can be deducted as a business expense from the company's taxable income. If the business has leftover profits, they are distributed to the owners as dividends, which have a lower tax rate than regular income does, as they are generally not subject to the Social Security and Medicare tax requirements. Electing C Corp taxation may make sense for some multi-member LLCs that retain significant profits within the company rather than distributing them. Retained earnings are generally not subject to the double taxation that is often associated with corporate taxes.
All right, so kind of synthesizing everything that Jennifer just said, what are some tax strategies, for holding companies, operating companies? There's a lot of considerations. Will the company real estate? Will the company give out shares? There's a lot of tax planning strategies that can be used. And one of the most common for operating companies that we recommend is an S corporation. And as Jennifer said, the Medicare and Social Security taxes, what they call this is SECA, or self-employment tax. And self-employment tax is actually 15.3% on the income before income taxes are passed on to you. And so how you avoid that is an S corporation. And you think, like, why is there self-employment tax on LLCs that come like that? Is because essentially that's the same thing as FICA. So when you pay employees, everyone's probably got a W-2 or had to pay employees, and you do have to, you withhold the employee portion, and there's an employer portion. And so what the IRS has essentially done is, that they know you're owning your own business, they force you to still pay that. And so that's 15.3% for that SECA tax. Now, how to avoid that? Rules under S corporation is that as long as the owner pays himself a reasonable salary, rule of thumb is about 1/3, then you only pay essentially the FICA and the SECA on that portion, and then the other 2/3 can come straight to the K-1 distribution without that self-employment tax. So as an example, let's say you made $100,000. Net profit after everything, paying all your expenses, $100,000 is your income. If you're not an S Corp, you're going to pay $15,000, roughly $15,300 in self-employment tax. Now, you can deduct half of it. I'm not going to go into the, actual tax return CPA part of it, but that's a tax you have to pay. If you, in the same scenario, if you were an S corporation, you could theoretically pay yourself a $30,000 salary or $33,000 salary, and then pay basically the SECA, the FICA. It's not going to be called SECA, but the FICA on that amount, because you're going to have to give yourself a W-2 and actually pay yourself. But then the other $66,000 has no self-employment tax and will just come directly to you. And so that can be a huge tax savings for people, especially operating companies. So that's one of the reasons why we recommend S Corp and operating companies, because there's significant savings. Now, we ask them to consider, are you going to own any real estate? Real estate is an appreciable asset. So typically in appreciable assets, we do not recommend an S corporation. You just keep that in an LLC. Now, why? As Jennifer explained before, if you're a single member LLC, you're a disregarded entity. So you're taxed as a sole proprietorship. So the IRS disregards your LLC for tax purposes, and they look at you as an individual. And so it gives you greater flexibility. You can transfer the real estate to somebody else, to your mom, your brother, your sister, whatever you want to do if you ever want to do anything. But that's not, maybe that's not as common. But if you did, for example, accidentally do an S corp election on and you have some real estate in there, and you try to move it to a new entity, you say, hey, I have this LLC, it's an S corp, I just want to move it to another LLC for whatever business reasons you have. You can't. You can only move it to another S corp. Anytime you move any significant asset, you have to follow like reorganization rules under the Internal Revenue Code. You can't just make a deed and transfer it over. So it would actually be considered a deemed sale. So you would have to pay tax on something you haven't even sold. So for example, so appreciable assets, no. But the real big reason is because, say you do want to do some planning for the future, and you want this to be passed out to your spouse, your kids. When you have a real estate in a single member LLC versus an S corporation, there's this thing called step up in basis. And so at death, we'll just do this exercise too. You have a property you bought for $100,000 20 years ago. You pass away, it's worth $1 million today because of step up in basis. Your children could sell it for $1 million and pay zero in tax. Versus if you didn't have that structure, you would retain that basis, and they would have to pay presumably capital gains on that difference, right? Depending on how much depreciated. It's a very simplistic example, but because for example, at an S corporation, I won't go too deep into it. There's no step up in basis there. So looking at what you're doing, what your company is doing, how you're operating, what assets it holds, these are all tax planning strategies. For example, we talked about corporations and are you reinvesting, right? There's like formulas that CPAs have come up with. And hey, if you keep continually reinvest for X amount of years, you actually save more than if it flowed through to you as a S corporation or as a corporation. So LLC, excuse me. So there's a lot of analysis of what your business is doing, what it's holding, and that kind of should guide you on what type of taxation you should choose. In conclusion, if you have any questions further on, you can contact us here. These are, we only kind of did a high level overview of all this. This can go very much more in depth. But this is the, kind of at least give you guys a head start on what to be thinking of. Do any of you have any questions? Actually, I do have 4 questions. So I will tackle them one by one. First question is, what is the cheapest legal structure for a small business? So we did cover that. The cheapest structure obviously would be a sole proprietorship. We would not recommend that because sole proprietorship costs $0. Or even if you just did an assumed name filing, that's like $25 or $30, something like that, or very low. So that would be the cheapest. However, we would not recommend that. Forming an LLC is relatively cheap. It's $300, but there's no one's going to pay via check. Most people pay via credit card, so there's a credit card fee. So as much as like $308.10. I've done it enough. That's the exact amount. So that's what an LLC would be, I guess, the cheapest true entity versus just getting into business. Would be a sole proprietorship. Question number 2, how can I reduce my business's tax liability through different corporate structures and tax strategies? So I actually just went through that. So S corporations, a good way for an operating company. C corp, maybe, if you have very, very large income and you're not really spending it, why pay 37% when it flows to you personally, when you can pay 21% and possibly, and defer that and push it down the road. There's a real analysis needed of what the business is doing and what assets are being held by it. And that is the best way to figure out a best strategy to reduce liability. But in general, tax liability for an operating company is an S corp. So question number 3, how can I protect my personal assets in the event of a lawsuit or bankruptcy? and what legal and financial steps should I take to minimize risk? Well, this is a little bit out of scope of this presentation because it leads into bankruptcy law. But in general, all the entities that we described, which are actual entities, LLCs, limited partnership, corporations, they provide, they provide protection to your personal assets. Now, that's assuming you didn't try to do fraud or piercing the veil that we discussed. But as long as you followed your corporate formalities, there's no fraud involved. If your business is sued, your personal assets are safe. And lastly, we have a fourth question. Oh, wait, there's more. There's a lot coming in. So here's for average cost to start on LLC. We covered that $300. So is there, let's see here. Yeah, let me see. Sure. So let's see. Someone asked, can I provide another real world example of businesses that have successfully implemented tax and corporate structures you're recommending and how they benefit from them? Yeah, like S Corp, I've seen it real time just this past year, where electing a S Corp saved a client that we know $15,000 just by doing that. And so I believe their liability went down from 96,000 to 81,000, something like that. So there is definite strategies to this. There can be more complex structures and multiple entities, but that I tend not to suggest to people to go there until the income is very, very high. I mean, there's no need for a Bentley right away from the beginning. So it kind of, as your business progresses and grows, your tax strategies have to grow with it. Because there's more than just income tax planning. There's tax on assets, selling, depreciation, bonus depreciation, buying cars. There's a lot. So, and then there's record keeping that goes along with it. So a lot of this stuff you have to kind of work with either a tax lawyer or a lawyer, a corporate lawyer, and your CPA, and they can come up with the best strategy. Because some of the stuff we can talk in concept, but we need to look at what type of income are you earning, right? Because there's different types of income. There's rental income, passive income, active income. And so all this needs to be put into like a spreadsheet, and then it's actually analyzed and predicted over several years. And then you can really, once you get to that more sophisticated level, that's when it gives you a real dollars and cents of where you're going to be. So that's my example on real world. So common mistakes, I went over that. Someone asked about common mistakes when choosing tax and corporate structure and how can I avoid them. So common mistake is if you know it's going to be real estate, do not do any type of corporation or S corporation, especially if you're a small business, because it's regarded, right? Those entities are regarded. They're not disregarded like a single member LLC, right? So when you're regarded, there's a whole set of rules that you have to follow if you ever want to transfer any type of property, other types of assets. There's not, real estate's not the only one. It's just very common here in Texas, but there's goodwill, IP, there's a lot of different stuff, right? So those are all considerations to take. And if any of these questions, I'm making a little bit more high level. If you want more of an in-depth, free field to email us, and we can try to help you out and give you a little bit more of a detailed answer. Is it because a C Corp might not be required? Yeah, so you don't have to necessarily do a distribution for a C Corp. And so there would be no tax paid by the shareholders. But of course, the C Corp would still pay 21% at the corporate level. I have another one. If you plan to open multiple real estate, own multiple real estate through an LLC, should you open one each for each investment, or have the same holding company for multiple assets? Now, this is a personal decision. Now, to us, opening another LLC, if you're sophisticated enough to have multiple real estate, ownership, $300 per entity is not that expensive. Plus the compliance costs, CPA, you're probably looking at $1,000, $1,500 per entity, and that's not a lot if you're holding real estate. Now, it depends on what you have. If you have multiple, this comes down to your risk appetite. There's some things as a lawyer, I can tell you as a lawyer, oh yes, separate LLC each. But then as a business owner, what's your liability? Are they I don't know, is it 3 homes that are worth $75,000 each? And then in comparison to that, what's your overall net worth? If you get sued and those 2 other properties get encumbered, will it really hurt you? You know, these are kind of things that you like as an individual, you have to think about. But in general, yes, we do recommend a different entity, but it depends on what type of property it is and what you're doing. Next question we have. Hmm. Oh, sure. What are the potential tax and legal implications of changing my business and corporate structure? So this is also a little bit out of scope here, but there could be consequences. Um, for example, there are, so you could end up with tax that you didn't plan for. So if you went one way and you decide you want to change to another way, there are several codes under the Internal Revenue Code that could be deemed sales, for example. And so you can end up paying tax. So this is a little bit more in depth, but yes, there is tax implications. Now, legal implications are a little easier because you want to say you want to change from LLC to you say you formed in tech as a Texas LLC, would you want to become a Delaware C corp? In terms of legal compliance, that's not that hard. You file something here for dissolution. You file something in Delaware. It's like a conversion, and you file this certificate of conversion, and you can easily convert even out of state. You're not even within state to a different state. But when it comes to tax strategies, it gets a bit more complex depending on what were you first. Where you flow through and then now you're becoming double tax, where you double tax and now you're becoming flow through. Because I believe if you're already a corporation and you choose flow through, then everything just automatically flows through, and then you could all of a sudden get a huge tax bill that you didn't really want. So again, that is something to definitely. That's why doing research on your business type is crucial in the beginning. Okay, so if my business doesn't make me any money, can I still write off my yoga classes and the business expense which I need to stay flexible? That's a good funny question. The yoga class has to be a true business expense, can't be for fun. So that's what it is. But let's just say it's a real expense like cell phone. Sure, if your business is not making money, you can write off. But after a couple of years, I believe it's 3 years. Could be wrong, maybe it's 4, but after 3 years, the IRS may come back and say, no, this is a hobby, and they don't let you write off any more expenses. So you have to be actively making a real business and start making money soon. But the first year or two, yeah, sure, you could technically write off a lot of expenses, phone, rent, and even if you haven't having any money, it's okay. How do I ensure that my business is fully compliant with all federal, state? Oh, wow, that's a very broad question. So, and honestly, this is more of a CPA question. But with tax laws and regulations, it depends on the entity you choose, right? You have a partnership, there's a 1065 return. If there's a S corp, it's an 1120 S return. Corporation 1120 return. Schedule C if it's an LLC, disregarded. All this income comes through K1s, right, or 1099s. So being compliant, hire a good CPA, because there's a lot of tight deadlines, right? Because it's not just federal income tax, local income tax. There's payroll taxes, 941s if you have employees that have to be done quarterly. There's Texas quarterly wage reports. There's and then if you have employees out of state, which became increasingly popular with, even though most people have gone back to the office after now that COVID has weaned down, there's still plenty of remote employees. So potentially compliance in a state far away from you. So having a good CPA, I would say, is the best because there's constant deadlines, every year, every quarter, and for different things depending on what your business engages in. And so that would be my best advice there. Is our firm able to assist with tax planning strategies that I should be considering? Sure, we do. We absolutely do. More higher level tax planning strategies. We stick to corporate structuring and from the more business and corporate law level. But of course, with basic tax structuring on the higher level, we do help with that. But say if you have a little bit more of a complex issue, then we have firms, CPA firms that we partner with, and that when you have a more sophisticated tax issue, that we bring them in and to ensure that we are coming up with the right tax strategy for you. I believe that is all the questions that we have. And if there's any other questions, please let us know now, or we will, I guess there's no coming in, so we'll conclude. Thank you everyone for attending. We appreciate it, and thank you very much.